By early 2026, the global trade map is defined by two fractured maritime choke points. In the west, a persistent drought at the Panama Canal has restricted daily vessel crossings, driving a 32% decline in transit trade volume. Shippers are left facing massive bottlenecks as large cargo vessels wait days to navigate the tightly confined lock systems. Simultaneously in the east, drone and missile strikes in the Red Sea have forced major shipping lines to abandon the Suez Canal entirely, rerouting cargo thousands of miles south around the Cape of Good Hope. The macroeconomic fallout is immediate. High transport risks have tripled maritime shipping rates and added 10 days or more to average transit times. For a commercial center like Dubai, which depends on transport stability and global finance, these disruptions represent a structural threat to the country's economic model. The UAE's response is the Comprehensive Economic Partnership Agreement, or CEPA NOBARC. Initiated in late 2021, the program abandons slow multilateral negotiations in favor of targeted bilateral treaties designed to rapidly eliminate trade barriers and secure direct market access. The data proves the strategy is working. Supported by 32 newly concluded agreements, the UAE's non-oil foreign trade surpassed $1 trillion by 2025. To achieve this, the Emirates built a four-layered trade architecture: strategic treaties, compliance rules, physical free zones, and sovereign capital. Surviving global shipping choke points requires moving past the passive concept of a geographic port. The UAE is engineering an active economic ecosystem. For decades, the Gulf Cooperation Council operated to create a unified market. That bloc is now fracturing as member states pursue distinct competing economic strategies. Saudi Arabia is executing an inward-facing model under Vision 2030, prioritizing domestic supply chain independence and local job creation. Riyadh relies on massive domestic infrastructure projects and directly mandates that foreign corporations establish regional headquarters in the Saudi capital to qualify for government contracts. The UAE takes the opposite approach. The We the UAE 2031 agenda uses bilateral treaties to secure direct access for Emirati exports into emerging markets containing over 3 billion people. This outward independence carries a geopolitical cost. Driven by production caps that restricted its output, the UAE exited OPEC entirely in May 2026 to fully utilize its expanded capacity of 4.85 million barrels per day. This chart compares the economic mechanisms of the GCC. While Saudi Arabia secured $25.6 billion in foreign direct investment inflows in 2023, the UAE's bilateral approach drove non-oil trade past the trillion-dollar mark. Riyadh leverages state contracts to build a localized walled garden. Abu Dhabi deploys international treaties to build external supply bridges. To prevent foreign manufacturers from simply rerouting cheap goods through these bridges, the UAE guards its treaties with strict rules of origin. This compliance table outlines the India-UAE CEPA requirements. Manufactured products must achieve a 40% regional value content. This is calculated by subtracting non-originating material value from the final export price, dividing by that same price, and explicitly excluding corporate profit. The treaties also include specific anti-rerouting clauses to protect domestic manufacturing, such as the melt and pour requirement applied to imported steel. Across these agreements, a severe transshipment penalty applies. Exporters must ship goods directly from the origin market to the UAE to access lower duties. Zero-duty access into the Emirates is a mathematical threshold that rewards rigorous corporate compliance. The regulatory math of the CEPA network is executed through physical corridors, starting at the massive container terminals of Jebel Ali Port. Adjacent to the port is the Jebel Ali Free Zone, or JAFZA, operating as the region's primary commercial clearinghouse. JAFZA offers a highly specific customs exemption. Goods imported into the zone remain exempt from the standard 5% UAE customs duty, provided they are stored, repacked, and exported outside the GCC without significant physical transformation. To capitalize on this, JAFZA is developing Bharat Mart. The facility provides 2.7 million square feet of space, where Indian exporters can store and distribute goods directly from Dubai, bypassing maritime delays. When ocean routes choke entirely, the UAE activates immediate overland alternatives, moving critical cargo by road and rail to bypass maritime disruptions entirely. In March 2026, the Hadda border route with Oman was established within 72 hours, operating under simplified customs procedures. Integrating deep-water seaports with immediate road and rail infrastructure makes JAFZA an operationally resilient supply chain hub rather than a standard tax haven. The final layer reinforcing this trade network is the aggressive deployment of Gulf sovereign wealth. Collectively, the 5 largest regional funds manage nearly $5 trillion in assets, representing roughly 1/3 of the global total. These entities have pivoted away from passive global stock portfolios, choosing to operate as strategic investors, taking direct stakes in high-technology sectors. Abu Dhabi established MGX, a specialized investment vehicle targeting $100 billion specifically for artificial intelligence and semiconductor manufacturing. This capital is deployed to secure physical footprint in partner nations. In 2024, the Abu Dhabi Investment Authority led an $8.3 billion investment into commercial real estate in China, locking down long-term commercial assets. Qatar adjusts its posture through similar deployments, introducing a trusted entity regime, granting tech companies immediate access to tax treaty benefits for alliances in Doha. Gulf sovereign capital is buying the physical and digital infrastructure inside Asian markets that will automatically route future trade back into the UAE's logistics network. Combining bilateral treaties, strict rules of origin, physical free zones, and sovereign capital creates a complete vertical trade architecture. This alignment creates a clearinghouse function where trade and commercial services are settled through Emirati legal and physical infrastructure. Individual free zones, corporate headquarters mandates, or massive sovereign wealth funds are powerful tools independently, but they cannot replicate this comprehensive ecosystem on their own. For businesses operating in the Gulf, the focus has shifted to how quickly a company can position itself to access the preferential tariffs and logistical redundancy this network provides. Corporations that treat CEPA treaties as mere regulatory paperwork will lose ground. Firms must build internal rules of origin compliance frameworks immediately to access reduced duties. With new physical connectivity projects like the Etihad rail network coming online, the physical integration of these supply chains is rapidly accelerating. In an era of fractured shipping lanes and maritime volatility, the UAE's infrastructure-first, treaty-backed model offers a level of operational resilience that bypasses traditional choke points.